It was American actress as Dorothy in The Wizard of Oz, Judy Garland, who said, "There's no place like home." In this lesson, we're going to compute the monthly cost of paying for a house, and we're going to explain the research that is necessary before you purchase a home. All to answer the question, what do you need to know about mortgages? Before we get into it, let's take a look at warm-up number 2. We're going to find to the nearest hundredth the value of M for each value of R using the expression of M below. Now, I'm not showing you the R values currently. We're going to go ahead and do this on an Excel spreadsheet. First, try and find it when it has a rate of 5%. By going back to spreadsheets we've already built, we can go ahead and figure out that with a rate of 5%, we pay $85.61 every month on this $1,000 loan. Now, try to figure out what it would be if the rate was 6%. And on the spreadsheet, we can see by changing it to 6%, we get $86.07 approximately every month. A house is probably the most expensive investment you'll ever make. Chris and Scott Halloran are opening a new restaurant. They take out a 3.9% 15-year $300,000 mortgage on the building, but they do not have a lot of money because they're spending what they have to get the business started. In the future, they intend to have much more money from the success of the restaurant. Can they get a loan that will fit well with their current and future incomes? How much will they pay in interest for the loan, and what are the monthly payments? The Hallorans can take out a balloon mortgage. A balloon mortgage features a very high last payment, with all other payments being relatively low. One type of balloon mortgage is an interest-only mortgage, where only the interest is paid until the final month. Note that since no part of the principal is paid until the final month, the amount of the principal owed does not decrease each month. It remains constant. To find the monthly payment for the Hallorans loan, multiply the principal by the monthly interest rate, which is the APR divided by 12. So we can take $300,000 and multiply that by 0.039 divided by 12. This is going to make it into a monthly rate for us. This is going to give us $975. The interest-only monthly payment for the first 179 months is $975. The loan is for 15 years, so they're going to make 15 times 12 or 180 payments. Since the last payment is a $300,000 balloon, the first 179 payments equal the interest-only monthly payment of $975. The 180th or last payment at the end of the 15 years is the balloon payment of $300,000. Notice that the initial 179 monthly payments were very low, allowing them to put the money into their business. The total interest can be found by multiplying the monthly payment, $975, by the number of interest-only payments, which is 179. So, multiplying by 179, we get $174,525. Keep in mind that they had to start saving for the balloon payment years in advance since it's so high. There are other ways to set up balloon payments, but all of them feature a large final payment. When you purchase a house, you will borrow money and have to sign a promissory note with many new vocabulary words in it. A loan for a home is called a mortgage. It is important to get familiar with the language of mortgages before acquiring one. Market value is the amount for which the house could be sold. Homeowners pay property taxes, also known as real estate taxes. Property taxes help pay for government services such as schools, libraries, and police. The assessed value of a home is the amount used to determine the property taxes. The assessed value may not be the same as the market value. After making a down payment, ideally of at least 20% of the house price, most people take out a mortgage to pay the balance. Because interest rates differ depending on type, length, and creditor, shopping for a mortgage is important. You should become familiar with the following mortgage vocabulary. A fixed-rate mortgage is a mortgage in which the monthly payment and annual percentage rate, or APR, remain the same throughout the entire loan period. An adjustable-rate mortgage is a mortgage in which the monthly payment and the APR may change as specified in the signed agreement. A foreclosure occurs when the bank forecloses on or takes possession of the home and sells it if the homeowner cannot pay the mortgage. Private mortgage insurance, or PMI, is bank-required insurance that covers you if you are not able to repay the loan. If a bank forecloses on your home and the sale of the foreclosure home is not enough to fully repay the loan, mortgage insurance can help. Homeowners insurance covers damages to the home due to fire and other natural disasters. It also covers the contents of the home in case of theft or vandalism. A mortgage loan is repaid over 15 to 30 years, which means a home buyer is taking on a long-term financial responsibility. Here, we're going to examine what costs must be researched by a prospective home buyer before committing to the responsibility of a monthly mortgage payment for many years. Now, let's compute the monthly costs of paying for a home. Heather is planning to buy a home. She has some money for a down payment already. She sees a home she'd like and computes that she would need to borrow $190,000 from a bank over a 30-year period. The APR is 6.4%. What will be her total investment for 30 years? Recall the monthly payment formula that we did in the warm-up and back in the unit, all about consumer credit. If we go to our Excel spreadsheet that we have already made, substitute in all of the values, we can find that the monthly payment is approximately $1,188.46. There are 12 payments in a year, so after 360 payments over 30 years, we see that the final amount paid will be $427,845.60. This is the sum of the monthly payments. If we subtract the $190,000 borrowed from that, we find that $237,845.60 is paid in interest. This is almost $250,000, and it is just interest. Buying a home is an expensive proposition. Let's check our understanding. Don and Barbara Weinstein are looking for a home for which they would have to borrow P dollars. If they take out a 30-year loan with a monthly payment equal to M, express their interest I algebraically. So I would be equal to the 360 payments made of their monthly minus the amount borrowed, and this is going to tell us exactly how much is paid in interest. Now, let's explain some of the research that is necessary before going to purchase a home. Jessica and Darryl Delaware are looking for a house, and they contacted a tax assessor to find out what the property taxes would be. In their town, the tax is based on the square footage and other features of the home. The ad describes their home is shown. What is the annual property tax on their home if the town has a tax rate of 89%? Property taxes are based on the assessed value of the house. The Delawares received information on how the assessed values are computed, shown here. Some of the assessed values are based on square footage, and some are flat rates. Let's compute the assessed value for each part of their home. We wind up with $1,800 and $3,375 and $400 and $252 and $450 and $384, a lot of ands going on here, and $750 and $150 and $125 and $200 and $700. This is going to be $8,586. The assessed value is $8,586. Multiply the assessed value by the tax rate to compute the annual property tax. The town has a tax rate of 89%, so we can multiply that by 0.89, and this is going to give us $7,641.54. So they will expect to pay property taxes of $7641.54 per year. Let's check our understanding of this. The assessed value of a home is A dollars, and the tax rate expressed as a decimal is R. Express the property tax P algebraically. Well, the property tax is the assessed value times the rate. Kevin and Cathy Mackin have a mortgage with National Trust Bank. The bank requires the Mackins pay their homeowner's insurance, property taxes, and mortgage in one monthly payment to the bank. Their monthly mortgage payment is $1,233.56. Their semi-annual property tax is $52.06. and their annual homeowner's insurance bill is $1,080. How much is the monthly payment they make to National Trust? The bank wants to ensure that the taxes are paid monthly so the Mackin do not have a large bill to pay at the end of the year. The bank holds the insurance and the property tax money and pays those bills for the Mackins when they are due. This is called holding the money in escrow. So the first thing we're going to do is divide the annual insurance of $1,080 by 12 to get $90. So they must pay $90 per month in escrow for homeowners insurance. We're going to divide the semi-annual property taxes by 6 and round to the nearest cent for the monthly amount for that property. This means that $5,206 divided by 6 will give us $867.67. So the Mackies must pay $867.67 per month into escrow for property taxes. The monthly payment to the National Trust is the sum of the mortgage, the insurance, and the taxes. Let's remember that the mortgage is $1,233.56. So when we add all three of these numbers together, we get $2,191.23. The Mackins pay the bank $21.91.23 each month. Let's check our understanding of this. Misha and Logan Zlotnick pay their mortgage, insurance, and property taxes in one monthly payment to the bank. If their monthly mortgage payment is M dollars and their annual property taxes is P dollars, their quarterly homeowners insurance is H dollars, express the amount they pay to the bank monthly algebraically. Well, we know they have to pay that monthly mortgage payment, and we know that they have an insurance payment of H. But this is quarterly, so it's every 3 months, meaning we can divide that number by 3 to find its monthly number. The property tax must also be paid, but it is given as an annual number, so we would divide by 12 to find out what the monthly number is. Tom and Kyra Courtney are considering buying a house and are researching the potential costs. Their adjusted gross income is $135,511. The monthly mortgage payment for the house would be $1,233. The annual property taxes would be $9,400, and the homeowner's insurance premium would cost them $876 per year. Will the bank lend them $190,000 to purchase the home? Banks use several factors, including credit rating, to decide if they will lend money. The bank wants to be paid back. They want assurance that the borrowers can afford the monthly payments. One indicator of this is the front-end ratio, which is the ratio of monthly housing expenses to the monthly gross expenses. So the front end is equal to monthly house expenses divided by monthly gross income. Banks often want the front-end ratio to be 28% or less before they lend the money. Now, the annual property tax divided by 12 will give us the monthly. So $9,400 divided by 12 will give us $783.33. We're going to round that to that nearest penny, and that's the reason for it. The annual insurance is $876, and we can divide that by 12 to get $73 per month. Their annual gross income is $135,511. So dividing by 12, we have $11,292.58. The monthly gross income is $11,292.58, rounded to the nearest penny. So the front-end ratio would be 1233 plus 783.33 plus 73 divided by 11,292.58. This will give us approximately 0.185, which is 18.5%. So the front-end ratio is 18.5%. The Courtney's front-end ratio is less than 28%, so the bank would say that they can afford the $190,000 mortgage on this house based on the front-end ratio. Let's check our understanding of this. Ken and Julie have an adjusted gross income of X dollars. They're looking for a new home. Their monthly mortgage payment would be M dollars. Their annual property taxes would be P dollars, and their annual homeowner's premium, H dollars. Express the front-end ratio algebraically. The first thing we need to consider is M, which is their mortgage payment. Now, their property taxes are given on an annual basis, so we're going to add the property divided by 12. The homeowners is also given on an annual basis, meaning we're going to take that H and divide it by 12. This is going to give us everything that is the monthly housing expense. Now, their monthly gross income is going to be how much money they earned that year divided by 12. Bill and Terry Noke are considering buying a house and need to figure out what they can afford and what the bank will lend them. Their adjusted gross income is $166,988. Their monthly mortgage payment for the house they want is $1,544. Their annual property taxes would be $9,888, and the homeowner's insurance premium would cost them $1,007 per year. They have a $510 per month car loan, and their average monthly credit card bill is $5,100. Would the bank lend them $210,000 to purchase their house? So in example 4, we learned the front-end ratio that banks use to assess potential borrowers. Banks also use a back-end ratio or debt-to-income ratio, which takes into account the borrower's regular monthly debts such as car loans, alimony, child support, and credit card bills. The back-end ratio is equal to their total monthly expenses divided by their monthly gross income. Banks generally want the back-end ratio to be less than 36% to approve a mortgage application. Now, to find their monthly homeowner's insurance, we take that $1,007 and divide it by 12 to get approximately $84 a month. Their annual property taxes of $9,888 could be divided by 12 to find $824 as a monthly expense. The total monthly expenses are the sum of the mortgage payments, property taxes, homeowner's insurance, car payments, and credit card debts. So, $1,544 plus $824 plus the $84 and the $510 along with the $5,100 means $8,062. To find their monthly gross income, we're going to take their annual income of $166,988 and divide that by 12 to get $13,916. So the back-end ratio will be equal to 8,062 divided by 13,916, which gives us approximately 0.579. So the back-end ratio for the Nokes is 58%. The back-end ratio for the Nokes is greater than 36%. The bank will not give them the loan for $210,000 based on their high back-end ratio. Let's check our understanding of this. Find the back-end ratio to the nearest percent for the Nokes in example 5 if they pay off their car and Terry gets a $12,000 raise. So we're going to remember that the back-end ratio is their monthly bills divided by their monthly income. Let's first figure out what goes on with this $12,000 raise. If they currently have $166,988 a year earned, and there is a $12,000 raise, now they make $178,988 a year. Dividing by 12, that means their monthly income is $14,915.67, rounded to the nearest penny. As far as their monthly expenses are concerned, they would still be paying the $1,544, which would be their mortgage payment. They would still be paying the $84 a month for their insurance, still paying the $824 a month for their property taxes. They would no longer be paying that $510 every single month, but they still have that credit card bill of $5,100 a month, meaning they have total expenses of $7,552. This means we're looking at $7,552 divided by 14,915.67. This would give us approximately 0.506, which is 51%. So their back-end ratio is still higher than 36%, though it is quite a bit lower than it was before. Chris and Scott Halloran are opening a new restaurant. They take out a 3.9% 15-year $300,000 mortgage on the building, but they do not have a lot of money because they're spending what they have to get the business started. In the future, they intend to have much more money from the success of the restaurant. Can they get a loan that will fit well with their current and future incomes? How much will they pay in interest for the loan, and what are the monthly payments? The Hallorans can take out a balloon mortgage. A balloon mortgage features a very high last payment, with all other payments being relatively low. One type of balloon mortgage is an interest-only mortgage, where only the interest is paid until the final month. Note that since no part of the principal is paid until the final month, the amount of the principal owed does not decrease each month. It remains constant. To find the monthly payment for the Halloran's loan, multiply the principal by the monthly interest rate, which is the APR divided by 12. So we can take $300,000 and multiply that by 0.039 divided by 12. This is going to make it into a monthly rate for us. This is going to give us $975. The interest-only monthly payment for the first 179 months is $975. The loan is for 15 years, so they're going to make 15 times 12, or 180 payments. Since the last payment is a $300,000 balloon, the first 179 payments equal the interest-only monthly payment of $975. The 180th or last payment at the end of the 15 years is the balloon payment of $300,000. Notice that the initial 179 monthly payments were very low, allowing them to put the money into their business. The total interest can be found by multiplying the monthly payment, $975, by the number of interest-only payments, which is 179. So, multiplying by 179, we get $174,525. Keep in mind that they had to start saving for the balloon payment years in advance since it's so high. There are other ways to set up balloon payments, but all of them feature a large final payment. Let's check our understanding. The total interest on a 20-year balloon mortgage with principal P is X dollars. If the interest is paid before the final balloon payment, express the monthly payment before balloon payment amount algebraically. So the total interest is X dollars. We just need to know how many payments are going to be made. We know that for 20 years, there are 12 months in a year. That's going to give us 240. However, we must subtract the last month, giving us 239. So there's 239 interest-only payments. So we can divide the total interest by 239.